Hello guys, welcome to my channel. Today we're going to be treating the guppy multiple moving average strategy. It's a kind of strategy that is a trend following strategy. You can use this strategy to follow trends when the trend is moving, to know when to enter the trend, when to exit the trend. Like, if you're finding it difficult to enter trades, especially in trending markets, so this guppy multiple moving average strategy will help you to identify trends, when to enter the trends and when to exit a trade. Yeah. I'm going to give you the setups, but let's set them up here and observe them and try and backtest them to see how it works. Yeah, so I'll come here. I've already set them on my phone, although I'm going to drop the parameters that I used on the screen. So first and foremost, let's go to work with them first before we get the parameters ready. So this is how it will look on your screen. Let's turn it over. Yes, it's something like this. So what you do with this strategy is to identify the trend, like where is the trend going to. So this multiple moving average strategy, it consists of two groups of moving averages. We have the short term moving averages, they are all exponential. The short term moving averages, 6 of them. Then the long term moving averages, exponential moving averages, 6 of them. Altogether makes them 12 exponential moving averages. They are the short term are 3, 5, 8, 10, and 12, while the long term starts from 15 and above, 15, 20, up to about 60 exponential moving average. I'm going to drop everything on your screen. On the screen, just make sure you watch the video to the end. So these moving averages, they have their own role that they play. The ones that are on blue here, those are the long term moving averages. These ones on blue, yes, they are the long term moving averages, while the other ones that are on red, those are the short term moving averages. You can set them to whatever color you want, but the two separate, the short term should be in a different color and the long term should be in a different color, so that you'll be able to identify both of them. So this is it. So what you do now is, after setting up the parameters you look for a position where there is crossover. If the short term crosses over the long term exponential moving averages, that means there is market change of trend, and the trend is changing. Like in this market now that we're seeing here, the market has crossed over. Yes, they've crossed over to the downside. That's from the upside to the downside, and the direction, you see that the slope has changed. It's facing down now. This is a downtrend. So the best form of trade to enter now is to enter for a sell, to follow the trend. This is the trend following strategy. So you follow the trend. The new trend here now is a downtrend, and you follow the trend. Once there is a crossover like this, then one other thing, there are several rules that are attached. Number one rule is that of crossover, which we have just seen here. This market that crossed over. Then another one is the market, when this group of moving averages, they move towards the short-term moving average, when they move towards the long-term moving average, then they reverse again in the direction of the trend. Once it happens like that, you continue. It means the trend is continuing. Like you can see here, the trend is continuing on the long-term direction. You can see it in other cases, like okay, around here now, the market crossed over here. In this place here, the market crossed over, and here the market came again. The the moving average, the short-term moving average, they they went they they were about crossing to the other side, but it failed. Then it continued going down again. When you see such opportunities, it means the market failed to cross over. That means there is continuation of the trend. Then you follow. So it's a trend following strategy. All you just need to put your eye on is the long term moving averages. Put your eyes on it, follow the direction, then look for crossovers and trade crossovers, and look for trades like this when the market will be moving towards something like this. Market will move towards a long term moving average, then continue down again. You look for such opportunities when trading this guppy multiple moving average strategy. Yes, it's a very good strategy. If you try this strategy, I I assure you will see more in gains than in losses. It's a proven strategy and it's not common. You will not see it just everywhere on the internet. Yes, so you see, the market moved here at this particular point, moved here, it failed, and it continues on this downtrend. You see it. If you go through your chart, you see something so many times that the market made such moves. You can see here, especially here. You see that the market tried to cross over, but it failed. Then it continued upwards. It came here again. It came here again. Tested. Continued. Yeah, this is a good sign of market continuation. Then another thing you need to take note of is the gap between the upper band and the lower band moving averages. That is the short-term moving averages and the long-term moving averages. The distance between them tells more about the volatility of the market. That is how strong the market move is. This gap in between the two tells you more about it. Sometimes you see that they will intertwine. When they twin together like that, it means there is consolidation in the market, or there's consolidation that market is not doing very well at that particular time. There is there is no volatility. There is low volatility in the market at that particular time. So you will see that it's intertwined. Like look at it here, just turning around, and a twisting around. Yeah. So it's a sign of consolidation. And when you see something like this, the best thing to do is to sit on your hands. You stay out of the market at that particular time until there is a crossover, a visible crossover. Then you continue on your trade. So you see, it's a very good strategy. You can try it. You can try it. You can use your demo to try it. Make sure you test it, back test it, and you're confident about it. You're going to like it. So this is the guppy multiple moving average strategy. You will not see it out there so cheaply like this. Yeah, so this is it. Then one more thing that I would like you to know is one crossover type that occurs once in a while. They call it the compression strategy. So in such cases, I'm going to show you an instance. In such cases, just a candle crosses over both. crosses over both moving group of moving averages at the same time. It crosses over both of them. I'm going to show you an instance by this market here. This candle here, you see that it opened above both of the moving averages, then closed below both of them. It's not inside any of them, it closed below both of the moving averages. So what you do in such case, once one long candle like this comes, this candle here is what I'm telling you about. Once a candle like this comes, let me point it out for you to see. Is this candle? This red candle, this black candle, this bearish candle here is what I'm saying. So once you notice something like this, after it usually occurs after a period of consolidation. So if something like this comes up, it means there is going to be a shift of market structure. So as a trader, what you do is immediately the candle closes, immediately that candle closes, I'm talking about this candle, this candle here, immediately closes, immediately this candle closes, what you are expected to do is to set market order. You set a buy stop at the end, let's say, let me select the right market. It's not buy limit, buy stop. So immediately this candle closes, what you do is you place a buy stop, and a sell stop order, okay, or a sell limit, either of them, yeah. So you place sell limit here, just at this point. Then let me set, okay, is a market that has already passed. I'm just trying to make a reference to it. So the next thing is, look at, you place a buy stop at the top here, a buy stop, you place a buy stop here, you place a sell stop, here. That's the lowest part of the market, the lowest point where the market reached. You placed orders there. So at the end of the day, one of them is going to be triggered. So when one is triggered, you delete the other one, and you make the point, the one that you deleted, you make that point a stop loss for the other one. Then you trail your profit down. You continue to change your stop loss and your TP. You change it continuously as the market is trending in your direction. You trail it until you are stopped out. Then you will realize that you would have made quite a lot. So one thing I really want you to know about this compression crossover is how to identify this particular candle. Like, so now I'm going to tell you more about it. This candle I'm telling you here, this one property that it has is that it has to cross over both moving averages, both group of moving averages. It has to cross through them at once. Then you see in this one, the opening price of this market was outside, that is, the market opened outside the moving averages and it closed below below the moving averages. So for you to choose this compression strategy candle, you have to identify these two properties. It has to have those properties. Let's look around if we see some other ones that has such properties, so that we'll be able to identify it, so that you'll be able to identify it on your own as well. So let's look more and more and more and more. You see them, and you can also check it on your own and look for such properties, and you discover that they are everywhere. Now you see this bullish candle here. Where is it? So I was about showing you that bullish candle before it disappeared. Let's bring it back. Let's bring it back again. This bullish candle, let me show you. See that it's open here below the prices, then close below above the moving average. It opened below the moving average and closed above the moving averages. Then what you do is, when you notice something like this, what you do is you place a buy stop here and a sell stop here. Then in this case, it triggered the buy stop, and then the market rallied up and rallied up. So that is how it is. So guys, if you found this content quite educating, please like and hit the subscribe button. It goes a long way to encouraging us to make more videos. Thank you very much.